So one thing that's surprising me, Matt, a little bit is this 10-year Treasury yield. I know right before it's not so specific on the docket, but Treasury yields are rising, and this is not the narrative that folks were talking about several months ago of lower rates in 2025. This idea that we've said for the industry has been saying for years, survive until 2025. We should see inflation really coming down. We should see lower interest rates, and really the market stabilizing. And there have been a lot of signs of the market stabilizing. Inflation is much lower than it was 2 years ago. That's for sure. But there's some more uncertainty. There's more speculation. We've got a new presidential administration coming in, and that is fueling the fire of maybe some more inflation. Maybe the Fed missed the boat a little bit. And they just got ahead of. They didn't miss. They just got ahead of themselves a little bit in terms of rate cuts. The economy was still going so strong. There wasn't the evidence that they had put enough pressure on the economy to slow inflation down permanently. Because ADP came out with a jobs report this morning. Unemployment is still going down. There's not very many firings that are going on, not many folks that are looking for unemployment insurance. We're going to get the full jobs report out this Friday. In some cases, it looks like the economy is going to be in a great shape in terms of wage growth, economic growth, the tax cut, when the tax bill gets redone this year, lower taxes, that should be an economic driver. But, too much growth and does lead to inflation. And so is it going to be stable growth and sustainable growth?
Yeah, that's what I wonder is this is it a product of just the increased economic activity? That's something that is actually borne out in all of the reports that we covered. Every time they hit on the economy, they're talking about, and interest rates are higher than we expected that they would be. So this is something that we weren't expecting a year ago, but it's kind of been building a little bit. And I think also, I'm a little worried about labor market softness in certain areas. I guess the quits rate is a little lower, which is fine. It just means that people want to, they're hanging on their jobs a little longer. There's a slight amount of uncertainty in the labor market, but I think that compared to other countries too, and we'll see this in the MSCI report, the U.S. economy did pretty great last year. Even the stock market, which had a little bit of tumble in December.
We're really complaining that the economy didn't really just slow down to a screeching halt, and that unemployment didn't go up. That's what's fueling a little bit higher growth and a little bit stickier inflation. And so, in one level, that's really not a horrible thing at all. Where it becomes a challenge and a problem as we see continued inflation that's persistent. And does that become sticky because psychologically folks are now returning that narrative of that we are going to see some longer run inflation? It hasn't gone away.
Yeah, because,
how much is this just speculation on tariffs and the whole Trump thing?
I don't know. We can talk about that.
A lot of that's
Put a pin in that,
too.
Please.
Yeah.
Well, because I think a lot of times when you hike up interest rates, you think that you bring it has a deadening effect maybe on hiring, on the labor market, and on the economy in general. And we hiked up interest rates, and the economy has been humming along, which almost makes you think wow, in the absence of that, would inflation have persisted?
Yeah, I mean, to me. And to others, what it seems like is, the goal of raising interest rates, the Fed funds rate, was to really slow down inflation, kill inflation, slow down the housing market, slow down hiring, prevent a wage price spiral, really just to throw cold water on the economy. And it's like the fire was burning so hot that we threw water on it, but it just evaporated all the water and kept burning. And we've thrown enough water on it. And at the same time, all the folks in the capital markets world, in real estate, anyone that uses, debt and leverage really throughout the economy, just basically just been complaining that interest rates are high. We can't do all the transactions we want to do. We can't do the deals we want to do. And the Fed's like, well, the economy's doing kind of fine. We're like, but interest rates are too damn high. And there's arguments well, they're kind of just normal, historically. But it's different than it was the last cycle. We want lower interest rates, and the Fed's like, fine, okay, we've kept the rates high, and for too long, fine, we'll start this path of decreasing interest rates, because by now we should have seen enough effect. We've seen a little bit of slowing, but again, looking around, anyone paying attention is like, the economy isn't doing that bad right now. It's not like we're seeing these signs, like the cracks aren't that deep.
Yeah.
Everyone was looking for the hyper focus on looking for the cracks, looking for the slowdown. And in retrospect, it's like, did we really see enough of it to justify reducing interest rates?
Yep. I wonder.
I was definitely in favor of it.
Yeah.
But
yeah, oh, for sure. I was, and I was too. And I still think that, like, I still think that the calls for, the Federal Reserve to raise interest rates or to keep them that much higher, like, I think that the economy can weather a few more interest rate cuts. I don't think that inflation is convincingly increasing. So there's lots of reasons, I think, to continue to lower interest rates, but that's not what the people that are buying 10-year treasuries are thinking.
Well, and especially, we were talking about this before we started the show, a lot of this, I believe, has to do with the new Trump administration, and some of it's real, some of it's really just over speculation. And you and I were talking about how shocked we are that some people still fall for the bait in terms of, hey, he's coming out saying he's going to do 20% tariffs, 30% tariffs on China. We know that that's not going to happen. We know that it's a negotiating tactic. They're going to deport, millions of people. Well, I mean, maybe we'll get back to the deportation levels that we saw under Barack Obama, but I don't think it's going to be nearly as meaningful. It's so much of it is rhetoric.
Yeah.
But people are factoring it in like absolute truth. These things are going to happen, not like they're negotiating tactics. And at most, you discount them by 50%.
Yeah.
And the people in the institutional elite media are certainly following for it. And there are clearly folks, whether it's in foreign investors, sovereign wealth funds, big institutional, they're clearly falling for it too. And they're saying, well, if they actually does what he says he's going to do, then this will happen. And so you're falling for it hook, line, and sinker. Yeah. Do you really think that all that will happen to the extent that is being described? Do you think that we're going to invade and take over Greenland and Panama? Yeah. And it's hard to adapt to a world of trying to filter through someone who says things that are being put out there for deflection, and it's strategic, and a lot of it does seem like ridiculous, but when you see it through like a strategic lens, it starts making somewhat more sense. But you look at the people who are taking it at absolute face value and are making $1 trillion decisions in terms of treasury markets and money flows. You really just have to scratch your head. But it also exemplifies how ridiculous some of the folks in those positions in the economy, leadership. Yeah, are.
I think that Trump's method of communication is to foreground like the dramatic things, and like he's not going to say we have a lot of these plans. It's a lot of nuance, little tweaks here. No, he's going to say universal 20% tariffs. Yeah. And there are things that make an impact. And
all he wants to do is he's going to he wants to go get a deal.
Yeah,
that's really all he doesn't care. He just
it's
wants
very
to
much
make
a negotiating
cool
tactic.
deal.
And then this is kind of skipping ahead to some of the notes I had elsewhere. But Cushman and Wakefield actually talks about this a lot, and they note that Trump tariffs the first time around were like 1% to 2%. So they're already kind of managing expectations there, at least in their account of tariffs. But I also think that that when you're talking about tariffs, you're talking about this like, it's a negotiating tactic. And the latest wrinkle is that the Washington Post has reported that these tariffs may be more narrow in scope than that 20% across the board tariff that we were so promised. Trump pushed back on Washington Post reporting, of course, because I will argue trying to get the specifics of these tariffs robs them of their power to terrify and delight. You get no tariff leverage.
Yeah, it's leverage. Yeah, exactly. It's leverage. Why would you want to?
And so I think that there is going to be some like twiddling of the tariff dials. I expect that for any one of these tariffs and for this entire package of tariffs, the feasibility is directly related to the negative impact on the economy, more probably the perceived negative impact on the economy. So if things are going bad and people are looking into tariffs, there will be pushback, and then maybe we'll ease off it. I looked back at like Trump tariff backlash on Google, and I for the first term, I was like all articles written from 2016 to 2021 or whatever, and the backlash was from Republicans. It was Republicans coming in and saying, no, let's dial this back. They're now China's tariffing our Harleys, if you remember that, and so
Well,
I'm
the
not
farmers
sure.
too. China, went after corn and soybeans, and that's where Trump bailed out the farmer.
Yeah.
The political, the ideological flip flop, on either side.
We'll see if
tariffs are
maybe,
protectionism, more of like a really more progressive liberal.
And we'll
policy.
see if Republicans come around to the topic of tariffs. But stranger things have happened ideologically.
Yeah, I'd be. I'm not a big fan of tariffs. I'd be more in favor of tariffs if they went along with eliminating the income tax.
Yeah. Well, and that's I think that's a big mess. But my point is, people are talking about this as a source of a great uncertainty, and I almost think that if it is a factor of the 10-year Treasury, then it's almost like more uncertainty than is needed, because you can't treat them as specifically correct words, as we all know with Donald Trump. Well, you have to look at the rhetorical meaning, and they're functioning as a negotiation tool.
Okay, so enough about politics and all of that. So multifamily market, where it's important, where the rubber meets the road, is the discount rate, the 10-year Treasury related to cap rates, and cap rates have been slightly declining since they peaked kind of earlier this year. They've been coming down, stable, coming down a little bit. People basically had called for the bottom in CRE apartment prices. But with rising Treasury yields, can that trend continue? Supply's coming down. We're seeing record apartment demand, according to RealPage, and what we're going to talk about. Investment sentiment is high. People, are bullish on the apartment and multifamily sector. And housing, especially rentals and multifamily, over the next 5 to 10 years. We'll get into what the Harvard says for the next decade after that. But for this decade, people are excited.
Yeah.
But if the 10-year Treasury is going up, it's hard to keep cap rates low. Cap rates at some point will expand because there is a normal spread between Treasury yields, 10-year Treasury, the risk-free rate, and the risk premium that one would like to earn on an unlevered yield or a cap rate on multifamily. So at some point, something's got to give. But what we're trying to figure out, why we're having this conversation, is this run up in Treasuries? Is it a blip pricing in all this rhetoric that is never actually going to happen? And we will see a return to sort of more normal interest rates. The 10-year Treasury coming back to 4% or below, settling at close to 3.5% is what kind of people think it might do. Or are we going to be in this 4.5 to 5-ish range? For a while, which means that cap rates probably need to be, an inch up, and there's truly going to be some more pain. And we talked to loan maturities that are coming up later this year in multifamily. That's really challenging because they can't get the prices to sell. And we have a lot of owners and borrowers that are going to be in a really tough spot.
Yeah. I think that's an important context. I think it makes it. I'm using it almost as like a symbol of the overall debt pressures in the CRE markets. Is this issue of loan maturities, because it's a nice key. You can kind of figure out the players and their motivations, and is it the CRE borrower that's got a loan that's going to be that has an interest rate that's going to go skyrocket? That's one angle. And then you've got the banks that are they going to give them a free pass this time versus that time? I think that loan maturity swelled in 2023, and we expected maybe that there would be, or some expected. We said that it'd just be a factor of the market, but there was also like some people speculating about how there would be a catastrophe because interest rates were high in 2023 and they were low 2 years before when those loans started. So was there drama? No. A lot of people got a free pass, I think, and now it's 2025. So.
The free pass was supposed to end this year.
Yeah,
that's the hard part.
I think it's.
Do they get another ride? Do they get another ticket to ride?
Well, and that's the thing. Is like I don't think the fact that it happened in 23 that doesn't make it not interesting today. I think that it's easy, probably sensible, to think there's a boy who cried wolf situation, but that avoids the really big questions that I keep thinking about: is how much of a factor is CRE maturities in any given year, whether it's 23 or 25, and how much is this year different from any? This year special? Is this year special from 23 because this is when the brakes come on? I think it's special because it's been going on for so long.
It's compounding.
Yeah.
You're compounding the problem. And then the difference between just any other year in CRE is the difference between rates, where those loans originated and where rates are today. A lot of times there's maybe not that big of a spread, and maybe rates are even lower than when they originated and all is good. But now when they're higher, then you've got valuations that are different.
The same problems that you had in 23, stagnant rent growth, high interest rates, they're the same right now, and they're probably going to be very similar in 25. There's not a miracle in interest rates that, at least the way that we're depicting it, maybe there is, but there's not going to be a miracle in interest rates that's going to change the way that works. And I don't think that rent is going to really rocket forward. So we're going to see maybe a lot of capital calls, or I said, if you lurk on the comment section, and I don't lurk, I read.
Where are you lurking?
The comment section of Bigger Pockets, LinkedIn, or maybe the real estate investing subreddit. You may hear speculative stories about the impending failure of some syndicators and or the owners' capital calls needing to keep some CRE deals afloat. I don't think they're going to be catastrophe or widespread. In fact, you know what? I'll go out and say right now, I hope nobody fails ever. That's what I hope. That's not what I think. I think that realistically, if I were a bank and I gave a borrowers a break in 23, would I be more or less likely to give them a break now? I think they'd be less likely to give them a break now. I think that it invites comparison. The fact that it happened in 23 and 25, it's like, okay, then figure out, is it going to be better or worse? And I think that it's probably going to be a little worse for borrowers.
But I think it's going to be worse. I think you're right. But can lenders, can they afford to wait? And will equity, can they afford to wait? Another 2 years, because I don't think patience is infinite for a lot of these groups. And they have investors, they have boards, they have mandates, and they also have to see they have to preserve principal and capital at some point.
Yeah.
And it's like, look, we gave you a shot, we gave you another shot, and like, look, just. Time's up. You've had 4 years, 2 years. You've had years to figure this out.
Yeah,
and we're still in this situation. And so here's the reality. Rubber's meeting the road, and you got to bring some cash to the table.
I'm not saying like XYZ is going to happen. I'm just saying like logically, this is how I'm thinking about it. The problems that were there didn't go away. You talked about cracks that weren't forming in the regular economy. I think the place where the cracks are these people, are these borrowers and the CRE. And the Fed noticed this and wrote a whole paper and said, all of these loan workouts, they're starting to have an actual effect in loss opportunity.
Do you think that they wrote that white paper with the idea, because it was written before the election, do you think that they wrote it with the idea that rates would be lower and then we would be in an environment where a lot of these workouts could take place and loans could mature and there wouldn't be that much pain? Almost it's like, hey, we're saying that it's safe, it's clear now, but now rates are up. And would they write the same paper again? Would they say, hey, look, you're going to have to incur some losses, borrowers are going to get wiped out, you need to go ahead and do it? Or are they saying, okay, well, we'd rather not see that much pain because there may be some systemic risk across different banks.
I don't.
Why don't we extend a little bit? I'm just curious if their position has changed.
I think that their position is, well, the economy was in a shaky ground in 2023, and it's not in a shaky ground anymore. You can take the hit, and whether it's due to interest rates or whether it's due to just like the general economy is not in that dire straits. We're not talking about Silicon Valley Bank anymore, but. That was my takeaway, but I had.
If that's the case, would it lead to like another regional, banking crisis? If a lot of this, the good thing is a lot of the debt isn't as underwater as the equity. The equity is certainly underwater in many cases. Lenders, if they can recover, they should be they should be fine to be able to get most of their principal back. Some office loans, maybe not as fortunate, but at least multifamily, at least the debt is mostly fine. Now.
So I think that, again, it's like, I don't think that this is like the same. It's not the same as 2023, and it's super interesting to me just to think about what is going to be different and what's going to be a factor. And I think that it is still worth watching, just like any. And I said this last year, just like last week with Jay. Anyone's watching the loan maturities, and you're kind of looking at maybe if loans are coming due in your area. If you're an investor and you're looking to buy something, you're keeping an eye on it. Well, just still keep an eye on it because there's more to this story as it develops.
Well, that's 100% the case. There are owners and borrowers who are waiting to try to figure something out this year, and it's not getting any easier.
Yeah.
So, all right, let's talk about this RealPage piece because we've been a little little doomier and gloomier just talking about treasury rates. But I mean, if you talk about the fundamentals of multifamily in terms of rental demand in the face of 4-decade high in new deliveries and supply, it makes one very bullish for multifamily, especially as new deliveries are starting to slow down